What's going on, guys? Hope you're having an absolutely fantastic day. So in this video, we're going to be talking about if the current rally is a bear market rally, right? So if we take a look at this chart posted by Charlie Balelio, these are the S&P 500 bear market rallies in 2022 to 2023, right? And you can see there's another one here, 2007 to 2009 and 2000 to 2002, right? So you can see it's not uncommon for us to have bear market rallies, right? Because some people will say like, oh, if the market goes up 10%, we're in a bull market, or if the market goes up 20%, we're in a bull market, or something like that, right? So they have all these arbitrary rules, right? But if you take a look at the bear market rallies, right? So 6.2% here, I wouldn't really consider that a bear market rally. That's just maybe a counter trend rally or something, right? So 11% would be something I consider a bear market rally, right? But you can see after this 11.2%, it's another 25% down before another 17.4% rally, and then down again, and another 15.1% rally, right? So you can see why people say it's not easy to trade markets, right? So because even if the direction is down, right, you can really get squeezed out when there's all these rallies, right? Imagine you put in a short here and you lose all your money here, only to come down here, you're like, oh, my short is finally in the money again, and then you get this rally here, right? So if we take a look at 2009, there are a few bear market rallies, but not as sharp as maybe in the current year, and not as frequent as well, right? You can see that this is nearly a 20% rally and then a 24% rally before eventually going down again. And I think the most was in the dot-com bubble, where you can see this 12.3% rally, and then this 9 close to 10% rally, this 10 point something percent rally. No, it's actually 19.3%, and then down another 40 something percent, up another 21%, right? So I don't think you guys can see the numbers. That's why I'm reading it out for you, because it's really quite small, right? And this is up 8% and this is up 21%, right? So you can see there's a lot of rallies, right? Especially when you take a look at the Nasdaq, it's even worse for the dot-com bubble, right? Speaking of the Nasdaq, we can see that the Nasdaq is down nearly up nearly 20% since December of 28, right? Of 2022, right? That is what? Maybe 1 month and 5 days, and it's up 17%, right? So absolutely insane performance. If we take a look at stocks like Tesla, right, you can see that Tesla went down, I think it was close to 75%, right? And then you can see the rebound has been quite sharp, right? Somewhere around 90%, right? Yesterday it was somewhere around 90%. I don't know why it's saying 75% here, but the bottom was actually 101, right? Not 108, right? Sometimes Google Charts doesn't capture the intraday bottom. Stocks like Facebook, I think it's up, 100+%, right? In the matter of 3 months, right? So Apple is the weirdest one. It didn't really fall, and it's not really going up that much either, right? So it's up 19%, right? So actually it did go up quite a lot, but it didn't fall that much, right? So from 170, I think the bottom was what, 130 or something like that, right? Brief thing to mention is that Apple is actually destroying shareholder value with share buybacks now, right? And some people might be asking, how can they be destroying shareholder value if they're just handing you out cash, right? So Apple is currently trading at a 26.25 PE. So if we take 100 divided by 26.25, we can see that their earnings yield is actually 3.8%, right? So they are buying back shares when the value of those shares are only 3.8%, right? Of course, you can add this dividend yield, but I'm not going to add the dividend yield, right? Because you have to pay taxes on it as well, and it makes the calculation even more complex, right? So if we take a look at the 1-year treasury, right? So the 1-year treasury yield is actually 4.6%, right? So about right in line if you add the dividend back in. But let me just say that obviously the 1-year treasury has no risk, right? And Apple stock has risk of fluctuation. You can buy back at 150 and maybe 6 months later it's going to be at $100, right? So that is something that you have to factor in, right? And when you compare a risk-free rate versus a rate that you have to take a risk, obviously you want higher returns to take that risk, right? And currently that's not priced into Apple, right? So that's why these are one of the signs that make me feel like maybe this is a bear market rally, right? Another one would be Google, right? It didn't fall that much. It's down like 41%. Okay, that's quite a lot, but compared to the stocks that went down 80, 90%, it's not that much. And then it's up 20%, right? So one theme that we can spot is the further a stock declines, right, the better value you get, and therefore the bigger the rallies are, right? So for Tesla, it dropped quite into value territory, something that I would have purchased at maybe $100, but I didn't get the chance to, right? Maybe I was doing my homework that time. I was a bit too slow on the trigger. So Facebook was a stock that I was in, but I sold too early because I needed the money for another play, right? Which was the Dow put play, right? So I should have just held on to my Facebook shares and call it a day, right? I would be up much more, right? Especially since the Dow is basically flat right now. So if we take a look at the last piece of the puzzle, which makes me feel like this is actually a bear market rally, right? And this might be my mind just playing with itself and trying to give myself confirmation bias, right? But we can see that 517,000 jobs added in January, right? So one way of looking at it is the Fed is actually going to engineer a soft landing, right? But the other way I feel to look at it, right, is maybe people are getting so stretched that they need to go get jobs, right? And that's why all these job reports are coming in stronger than ever, right? And credit card debt is also going higher than ever, right? So maybe these are some of the signs that maybe although the data is coming in strong, maybe that is a bad reason that the data is coming in strong, right? So that is something potentially I'm thinking about, right? So another thing I want to really talk about, why I feel this market is slightly irrational right now, is Google and Apple's growth, right? So you can see that Apple's revenue actually fell 5% year over year, right? And if you take a look at what Apple is trading at, it's definitely not indicative of a stock that has negative year over year revenue, right? So 26.5 PE, you would expect if you use 1-to-1 PEG ratio, maybe you would expect Apple to be trading at 26% growth, right? And if we take a look at today, this is something very weird, right? Which company gets a report negative 5% year over year? If you adjust it for inflation, right? Basically, they are negative 12% year over year, and their stock went up. Isn't that funny? So maybe Apple is just such a phenomenal company, or maybe the market is being irrational, right? And if we take a look at Google's revenue increased 1% year over year. So not even beating inflation anymore, right? So of course, one thing to briefly mention is that they are comping over maybe hard year over year comps, right? You can see that this was the pandemic, and then it shot up 54%, and basically now it's negative 5%, right? But I do want to mention that the reason that there is this positive 54% was because of this 0.5 and 1%, right? Which is very abnormal. It was during the lockdown and everything, right? So same story with Google. Advertising trends fell like crazy, and then it boomed, and then now it's back down, right? So we have to see, right? But I think these are pricing to perfection, right? Especially Apple, right? You look at 26.25 PE ratio and negative 5% year over year revenue growth. I don't think that's adding up, right? So Google, I think maybe fairly valued. I not something that I would be buying right now, because there are maybe other opportunities such as Baba, which is still trading at like I think 12 or 13 times free cash flow. So liquidation value is very close to that. So that is something you can really think about if you are willing to take the Chinese risk or the VIE structure risk, right? So these are the signs that lead me to believe that this is actually a bear market rally, right? Because the moves have been really sharp, which is quite common during bear market rallies. So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel, and also watch till the end, right? Because obviously you don't want to miss any important information. So you can see something like Tesla, so up 75% in the past month, right? Look at Facebook, past I think two months or 3 months. Yeah, past 3 months, it's up 100%. So Facebook, I wouldn't really say that, I wouldn't really have too many bad things to say about this, because actually it was quite undervalued, right? But I think Tesla went from maybe fairly valued or even slightly overvalued, because we are going into a recession, probably. Maybe recession cancelled after this jobs report, right? Who knows, right? But if we are heading into a recession, right, I think the P ratio that Tesla was assigned and the free cash flow ratios and everything was way optimistic even here, right? But then it went here, right? So this is something that we have to look out for. And another thing that I want to mention about Facebook, right, is that actually most of this rally came because they announced, I think, a 40 billion share buyback plan, right? So I definitely think it was a good idea for them to buy back shares at the 90 to maybe 150 range, right? But getting to this range, I don't think it's maybe fairly valued, and you never want to buy back stock when it's fairly valued, right? Especially if you are Facebook and you have so many aggressive growth opportunities to go ahead and pursue, right? So maybe that is another sign that is showing distortion in the market, right? And then I see some things like meme stocks and maybe BuzzFeed stock going up 300-400% after they integrate with OpenAI, and another stock that I own actually. So Nerdy stock, it went up like I think 30-40% because it was integrated with OpenAI. So I'm lucky I managed to sell some yesterday, right? I actually saw this news and I sold some of it, right? So the fact that you just announced a partnership with OpenAI can send your stock up 40%, right? Then it leads me to believe that it's still some irrational exuberance in the market, right? And that people still have some money to basically punt on these stocks before eventually a recession comes or something like that, right? Because if we are in a really depressive state in a recession, no one will be doing this with their money, right? This is absolutely crazy, right? Unless you're saying this is algorithmic, which it does look like, because you can see that after that the stock just tumbled 20%, right? So it's possible that it is algorithms buying. So there are actually a lot of signs that this is a bear market rally, but obviously I might be reading the information wrong, right? This is just my personal opinion, right? That probably the reason that our job reports are coming in stronger and stronger is because people are actually forced to go back to work, right? Because some people that might have thought they were retiring on their stock portfolio have their stock portfolio down 80% or 50% or something like that. And maybe some other people that thought they were going to retire off their real estate property, now that they tried to sell their real estate property, they can't sell it. Or now that they're trying to sell it, it's 10% lower than they thought it was, and maybe they want to make up that shortfall by working or by getting a part-time job or something like that, right? Or crypto bros retiring off crypto at 31 years old. So suddenly they realize that this is not a realistic plan because Shiba Inu is down 90% or something like that, right? So I do think this is quite a big possibility that we are only adding jobs because people need the jobs, right? Because if I keep taking a look at the credit card debt and the amount of credit that's being used, right, it's really clear signs. Let me pull it up. So if we take a look at total debt, right, we can see that it's climbing and climbing and climbing, right? So this really does lead me to believe, and this isn't updated, right? Because yesterday there was another set of data that came out and it's even higher than this, right? So this really does lead me to believe that people are, financing basically their lifestyle, right? And this jobs is basically because now that they can't finance their lifestyle anymore, now they're moving into jobs, right? And you can always see that I think it's at 3.4%, right, the unemployment rate. And we always know that the unemployment rate is the lowest before a recession, right? So basically a lot of conflicting signals. I haven't really, I don't have like 100% thing. Obviously I never have 100% thing, but at the moment I would put it at like 70%. I still think that this is a bear market rally, and 30% I'm like, maybe this is not a bear market rally, right? But even if it's not a bear market rally, I don't find this valuations particularly compelling, right? So you look at Tesla with a 52 PE ratio, maybe not the right way to value this company, but for simplicity, I'm just going to use that, right? I don't think this is very sustainable, especially if they're not growing as fast as they think they can. If the EVs are going to slow down, maybe tighter margins. Obviously, I think it's very good in the long term, right? And perhaps the whole market has priced that in, right? Because in the long term, they're going to destroy their competitors, right? Just put it plainly. But something like Facebook trading back at a 23 times price to earnings, of course, it's not indicative of what Facebook is trading at, right? But I think it's still like a 20 times free cash flow or something like that now, which is quite expensive considering that, they are burning through money like crazy on the metaverse, right? And then you look at Apple trading at this kind of PE ratio. So I don't want to bag on them too much, but I don't think this kind of ratios are too compelling, right? Unless you are willing to pay maybe a 20-30% premium, because these are, strong mode huge mode companies, right? And that is up to you, right? Because I think I can find other high mode companies that have maybe more compelling valuations, right? So that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.